Hi, I'm Anthony Parent of Parent LLP IRS Medic, and today I have attorney Robert Hansen joining me. We're going to be talking about taxation of foreign investments into the U.S.
Right.
And IRS Form 5472. 72. Tax reform has passed last year, and I think, from our clients, we're hearing a lot of buzz. People are very excited about some of the things that are coming up.
Yep.
We're seeing the enterprise zone, Section 1400Z.
Right.
There's a lot of things going on, and I think, the number one thing is the 21% corporate tax rate for C Corps, and those are corporations that are taxed as their own, not on the individual level. And we've been hearing a lot of buzz. We've been hearing a lot of buzz from our clients saying people are looking to move stuff out of Europe,
Right.
bring it to the U.S. And so we figured it'd be a great time to sort of give you a little bit of a primer if you are considering investing in the U.S. or if you currently are,
Yep.
some of the things to look at. So what's the basic rule on income taxed in the U.S.? What would you say it is?
Well, you've got your effectively connected, and you have your FDAP, your fixed determinable annual or periodic,
Okay.
as your two general categories. Not always obvious which one you'd rather be in. Sometimes you have to be in one over the other. But that's kind of your two general categories for what, if you're a foreign investor and you've got some connections to the United States, those are your two kind of general categories that you might fall into.
Okay, so we got to look out for that if you want to be treated as FDAP or
Right.
Effectively connected.
Right.
Okay. The other things that we see, and I think that one of the big things that comes up is people aren't aware of some of the reporting requirements we have. And then really one of the big ones is Form 5472. That's really an important one.
Yes.
And I was looking at the statute, I believe it's 6038A. I was looking at that the other day because I like to do that. And I noticed
it's what you do with your free time.
It's what we do. And I noticed something because the last time I looked at it must have been last year. I looked at it. I said the penalties increased. The penalties went to $25,000. They were $10,000. So why don't you run us through what a 5472 does, its purpose, and kind of what goes on it?
Sure. So you could almost think of the 5472 as the almost flip side of 5471. 5471 is for a U.S. person that has an ownership in a foreign corporation. 5472 is for a domestic corporation that has at least 25% ownership by a foreign person. Plus, there's some other things. So it's not just the ownership, but also if you have any related party transactions, which can get kind of complicated and can even catch some people off guard. Largely people who have who live abroad with non-U.S. spouses. The attribution rules for the ownership can flow to them. And they're not even a U.S. person in any sort of way, but it's still, the rules still apply, still flow, so you could have a 5472 requirement and not even realize it.
Okay, so when I think of related party, I actually don't think of relations. I actually think of maybe the money was going to a corporation, a foreign person owned.
Right.
But you're saying also look out for spouses too. That could also impact the
Yes.
requirements.
If the spouses also provide some type of service. So if your wife, for example, you're living in the UK, your wife is not a U.S. person, doesn't technically own the company, but she still does some of the bookkeeping for you or something like that, and you've officially paid her a little something. That creates that requirement, and you could have, like you said, a large penalty and not even realize it.
That's right. Now, I would say this, the change in 2017, this was a big change. Now, we say the Form 5472 is for a foreign-owned domestic corporation, except we're talking about tax. So when we say corporation, we just don't mean corporation. We also mean things such as...
You could have an LLC.
Yeah, the IRS changed the rules to make to make a foreign-owned LLC subject to 5472. And really where we see this, or as I say, where we want to see foreign-owned LLCs is with real estate. There's some real hazards, by the way, if you are investing in the U.S. and you are a foreign person. Something you have to be very careful about is that if something is in your name and, God forbid, you pass away, there's a U.S. estate tax on your U.S. property, even though you are not a U.S. person. Now, here's the thing. Most people don't know about it. The IRS isn't even enforcing it. I've kind of brought this up. I guess maybe I shouldn't have. But while they were hammering on, the IRS has been hammering so much on foreign accounts overseas as an endless source of revenue.
Yep.
And that the Foreign Account Tax Compliance Act, the IRS claims, will raise an extra maybe $1 billion a year. I don't think it has. But if you look at the foreign estate tax for people in the U.S., I calculated about $180 billion of revenue a year that could be collected if they bothered to.
Right.
I'm not saying they should. I'm just saying I think as a tax advisor, as a real estate broker, you have to be telling your clients, make sure it's not in your name, because that will wipe out. I mean, not wipe out, but it will really hurt if the IRS does start to enforce it. But we've seen this in the past. I think if you asked anybody about what a FBAR was in 2006, they would be wondering why.
Yeah.
The IRS doesn't enforce that. We're not worried about that. But then we saw immediately overnight, it now becomes the biggest deal to the IRS.
Well, I think you can use the whole FBAR and the general international tax enforcement campaigns of the past 8-9 years at this point as an example of what could happen. You know, they don't always get to it right away, but now the international stuff is on their radar. Period.
Yeah, right.
So it's probably going to take less time for the IRS to get to other international stuff than it did take them to get to the FBAR stuff right away. So I think it's an example. I think it's kind of like this is what it's going to look like. No one's going to care about it until everyone has to care about it.
That's right. Yeah, and then it's going to be overnight, and then the IRS will be acting as if they knew about it the whole time. So I think that's the important thing to know, is you want to make sure you're not setting up yourself for some failure down the road or setting up a headache for someone else. The U.S. is providing, I think, some terrific investment opportunities right now, but I think a call perhaps with a tax advisor like us, I could say like us, before you invest a substantial amount of money, to avoid a lot of the things that are going to and that we know from experience that are going to trap a lot of people.
And the thing is, for a long time, a lot of people in the profession, you didn't have to worry about something abroad too much because the IRS really wasn't going after it that much. And the really few really good ones were for people who had it for their clients on their radar already. So you can't just kick the can down the road and saying, they don't enforce it, don't worry about it. You need to know about this, because as the OVDP, the streamlined procedures show, when the IRS does get to it, they're not going to treat you well.
That's right.
Or at least not well by your standards.
And I think you're reminding me of something. There is the Form 5472 penalties that are now $25,000. Now, that is something that gets charged to the corporation, not to the shareholder, the foreign shareholder. So this is what's important. If you do have 5472s that are outstanding or substantially incomplete, you might want to look through doing an official disclosure program just to put a cap on what those penalties could be. Now, I think $2,500 or $25,000 penalty only applies for 2018 going forward. I think everything back is still the $10,000 there.
Still, those add up real quick.
Oh yeah,
because if you had to do it for maybe 1 year, you might have more than 1 year.
More than 1 year, and it's for that 25% or more owned by a foreign person.
Owned by a foreign person, also with some type of related party transaction. Okay. Well, we're going to be doing a video. We talked to one of our other attorneys, Sean O'Connor. This is going to be his. He wanted to handle the next subject, so be sure to subscribe, because we're going to be talking about the FDAP versus the other treatment, the effective connected, sort of weighing the pros and cons about which way you would want to be treated for tax purposes for your investment in the U.S. So, Robert, thank you for joining me today. Thank you for having me.
This is Anthony Parent for Parent LLP IRS Medic, and be sure to subscribe, and thanks for watching.